My name is Daniel Stanley. I'm an ETF specialist at BMO Exchange Traded Funds. And I'm joined today by my friends and colleagues, Chris Heakes, portfolio manager for all of BMO's equity and multi-asset ETFs, and Sohrab Movahedi, managing director, financials research at BMO Capital Markets. Today, we're going to be covering the recent bank earnings announcements and what they mean for investors as well as the Canadian economy. As well, we're going to be looking at different ETF strategies that give you exposure to the Canadian banks. So, gentlemen, without further ado, thank you for taking the time to join us, and let's get started. And Sohrab, we always start with you, and I want to do the same this time. And particularly, I'm interested in hearing about this because analysts have been revising bank EPS estimates, earnings per share estimates, lower pretty much since last June. And on our last podcast, you made a comment, and I'll quote here. You said, rate hikes will hurt the banks, margins will be lower, loan demand is expected to fall, and organic earnings growth is likely to be flat. How did the banks do this quarter? And was there anything in the results that contradicts your thesis that we're in the early stages of a slower growth period for the banks?
Yeah, I think so. It's good to be back. Thanks for having me back. Look, the third quarter for the banks, let's stick to the six large banks. Only one bank exceeded consensus or our expectations in the quarter. The other ones were misses to varying degrees, I think. And the bank that did beat had some tax rate tailwinds, right? So the thesis or the drivers that you were talking about, slower loan growth, basically the higher rates hurting volumes, margins, and the like, I think that's largely intact. I think what we've heard with a louder voice from bank management teams is that they're going to focus on areas that are within their control. Well, what control they have control over their risk appetite, ultimately how much risk they're willing to take. But I don't know if that's a near-term answer to a slower earnings growth. That can have some wins near term, but it may also have some medium and longer term implications. And in any event, may take a bit of time to play out. But the more immediate lever that banks will have, probably companies in general, but certainly banks will have, because so much of the expense base of the banks as people is to manage their headcount and their expenses. And I think what we got this past quarter was some elevated people-related severance charges and the like at the banks. And I think we got indications that there will be more of those sort of expenses probably in the fourth quarter. The quarter we're in, that doesn't end until the end of October. They won't report it until December. So I think that's point number one, that expenses are now very much in play. Expense management is a priority, and part and parcel in that will be some kind of headcount reduction. And I think Royal Bank, the country's largest bank, talked about reducing FTE by about 1% last quarter, with a further 1 to 2% kind of reduction in the fourth quarter, the one that we're in right now. And BMO, which is a bank we work for, obviously, and we don't rate, but they had elevated severance charges and the like. The second thing I think that's going to be interesting, and I don't know if we got out of the quarter, we obviously expect normalization in credit costs and provisioning for credit costs. So remember that we had all this really excess government support that came in to keep up, to hold the economy together as in response to COVID. That probably delayed what we were embarking on back in 2019 as far as a slowdown in the credit cycle anyway. And so we're starting to get the credit cycle come through, with the difference that there was an ample amount of liquidity pumped in. And I think normal credit, I shouldn't say normal, historically, the credit cycles seem to have a clean peak associated with them when it comes to provisioning expense. Think of it as a Rocky Mountain kind of peak. We are starting to seriously contemplate whether or not, to stay with the mountain theme, the credit cycle this time around may look like Cape Town's Tabletop Mountain. You will have not a clean rocky mountain peak type that we have historically had during economic cycles, but a few years of higher and growing, but not spiking PCLs. And so, for anyone who could try and take a visual of that, perhaps the area under the curve will be the same, but the shape of the curve will mean a bit of a plateau top, a mesa of sorts, if you will, as opposed to a peak. And I think that we wonder how long it will take for that conclusion to kind of be validated, right? So we've seen a bit of a normalization in credit cards. The PCL ratio is still around the call it through the cycle averages, but it's certainly drifting higher. The question is it going to spike or is it going to be a drift? And I think part and parcel of that's part and parcel of what sort of an economic outlook do you have. And I think I think a shallow, I don't know if I call it a shallow recession, but certainly a soft landing scenario now seems to be the base case. And I think if you're in a 0.5% GDP growth environment, I'm not sure if that's very different than if you're at a minus 0.5% GDP growth environment. One's a recession, one is not. Both are anemic growth. And so I think those will probably have to still get reflected into the estimates. We revised our estimates a little bit lower for the out years. I wonder if the sentiment towards bank stock certainly fundamentally will become a lot more constructive when we start looking at 2025 earnings estimates, which we haven't rolled out. We will roll out next quarter. We will have a better sense of what the exit velocity, if you will, for 2023 is going to be. I think 2024 is still shaping up to be a bit of a I would say challenged operating environment for the banks. Certainly, they would have some visibility into the first half of the year, and I think the commentary is managing expectations lower. But I think as we start looking to 2025 and beyond, the case becomes stronger. So probably a bit more than just a quarterly recap that you were looking for, but hopefully it gives you a bit of a perspective as to kind of how we're viewing the space today and over the next 3, 6, and 12 months.
Oh, thanks, Sohrab. I love that perspective, and I love the analogy of the sort of peaks versus the rounded mountain. The area kind of being the same, maybe that drags it out a little longer. I'm curious, and what I love about these sessions that we do, Chris Heakes, what I love is that we can talk about the numbers and the results, and then we can look at what the market thinks of those numbers and those results. What are you seeing from the perspective? We heard the announcements were weaker from the market. If you look at the performance of ZEB, which is the equal weight Canadian bank ETF, talk to us about that price behavior. What does the yield look like? And what are trading volumes and flows on that ETF like?
Yeah, thanks, Dan, and good to be here again. The price behavior largely followed the fundamental behavior, and I suppose that's what you want to see in a kind of somewhat of an efficient market. With earnings generally a little bit disappointing to the downside. Sohrab mentioned ZEB, the BMO equal weight Canadian Banks Index ETF, kind of followed suit, was down 3 to 4%, kind of off of earnings. I'd say since then it's kind of trending back up. So, a lot of that ground that was kind of lost in that kind of 1 to 2 week span around earnings has been recovered. We had seen inflows as banks have sold off, which is good, and it's nice to see investors recognizing the opportunity. But, at the same time, I think it's fair to say there are some somewhat more nervous or concerned investors. If you look at the Canadian banks this year, now with this kind of recent recapturing of what was lost, they're about flat on the year, just up 0.7%. The TSX is up 7%. Some of those growth elements like Shopify and IT helping the TSX this year. So, about 6% behind the TSX. You look at last year, banks underperformed the TSX by about 4%. They were down 10 last year. The TSX was down 6. So you're seeing, certainly some concerns, I think, so, we've been working through that, and, I don't want to go too heavy on the numbers here, but I thought, one thing that we looked at that was interesting is just looking at, we know banks as a long-term investment are very, very strong. And we looked at, when banks have a negative calendar year, which they did last year, what's the average return the next year? And it's plus 12%. Obviously, we're not experiencing that this year, but that's the average over the past 35 years, as far as we could get the data. Now, 2 years, if they have 2 negative years, which up until recently, we are tracking for a negative this year. Now we're slightly positive, but if they have 2 negative years, which only happened twice, it happened in 2000 and 2009, where they had 2 negative calendar years, your average return the next year was 46%. So, very strong, obviously. So what am I saying here? Yes, we've had some kind of, mixed operating environment challenges for sure. Banks are going to be looking to cost contain and try and improve the numbers on that way. But, the yield, to your question, 5.1% on the ZEB. Traditionally, banks over 5% is a pretty attractive level. And I'm in agreement with Sohrab, and my preferred view is not so much the 3 to 6 month view where it's tough to forecast the challenges that are going to come, but that 2025 and beyond type view. And I think based on some of those negative price performances the past 1 to 2 years, the future looking brighter on a 2 to 3 year time span, especially as we could kind of look through the time horizon. So again, with banks yielding over 5%, that's a pretty attractive level. Certainly helps in the meantime if banks are not necessarily having the capital appreciation, you're getting that 5% dividend, and and position yourself for more capital growth potentially in the years ahead. So that's what we're seeing. Certainly, like all equity investors, some anxiety, but the anxiety also creates opportunity, and we have seen some inflows to the Canadian banks net, which has been nice to see.
It's interesting. It sounds like it is a mirror image of what Sohrab was talking about, where the PCL, historically, it sort of spikes like a rocky mountain, but maybe we're seeing a more rounded. What it sounds like is the performance of the bank equities, mirror image of that. Maybe, you said flat 2020. Maybe it is going to be a rounded, a slow, but not necessarily significant drop, which sort of makes sense when you look at a 5.1% yield. Very attractive for investors to hold on to a 5.1% tax efficient yield while they wait for that flat ditch, shall we call it, to gradually recover over time. So Sohrab, I want to come back to you. Canadian investors, we tend to think of the big 6 banks as a monolith. We always group them together, but in reality, you're very well aware of this. They are quite different in where they tend to allocate capital. BMO and TD, as we've seen recently, tend to be focused on the U.S. RBC, very, very focused on wealth management, global capital markets. Scotia, historically focused on the Latin American market. CIBC, very focused on the domestic market. Where I want to ask you the question, and where I'm curious is, do those differences, is it enough of a difference to translate into better relative financial performance over the next couple of years?
Yeah, I mean, it's a good question. I think just to kind of go back to what Chris was saying, we do think about the Canadian Bank Index, obviously. So there we don't really distinguish between them. Just to add a little bit to the data mining exercise that Chris was just talking about. He was talking about the absolute return of the bank index. If I think about the relative return of the bank index to the TSX, so the composite, it's interesting that going back to around 1970, which is the data set we kind of look at, and this is, I'll call it a bit of a data mining exercise, 3 consecutive years of underperformance is non-existent, right? So we did have underperformance last year. We look to be underperforming this year. And the markets being forward-looking and what have you, maybe some of that benefit that we're talking about with respect to 2025 and beyond will start getting reflected in the valuations in 2024, for example. So it's a calendar year basis. It's a data mining. It's fun little exercise. I thought I'd give you that. But if you start kind of then disaggregating this monolith, as we call it, the bank index between its component pieces, I do think the differences become incredibly important if we are talking about basically strategies for growth here. So let me come at it slightly differently and say that if we have this kind of rounded mountaintop on PCLs, as we were talking about, if sentiment remains a bit tired, if marginal buyers of Canadian banks, if non-domestic marginal buyers of Canadian banks, which have to really first be sold on Canada, remain a bit cautious kind of on the macro, then stock price moves higher are unlikely to happen anyway near term through multiple expansion. And so the way up will have to be pushing the earnings up. And there the strategies become that much more relevant. I think banks that have made acquisitions, have gone out and acquired earnings growth, I'll call it, probably are a bit more advantaged. In this regard, BMO unrated by us, but last long weekend would have been the actual conversion weekend for the Bank of the West transaction. So, provided they can execute and deliver on the synergies and the like that they've advertised to the market, they have some installed growth, I'll call it, because of the acquisition. Royal Bank, similarly, yes, good in wealth management, but the acquisition of HSBC Canada, which will probably close sometime in the first calendar year, let's call it February, March timeframe. Again, relative to Royal Bank, not a massive acquisition as far as an earnings growth driver, but certainly provides some earnings growth support. Whereas the others maybe kind of have to work a little bit harder, be a little bit more of a self-help story. Now, I think National Bank, as an example, may benefit from some of the disruption that will undoubtedly be caused by Laurentian Bank strategic review in Quebec. There's going to be disruption market over there relative to National Bank. There's going to be some opportunity to improve on things organically. But banks like TD, which are sitting with a bit of a Department of Justice type uh, um, restriction on them around capital deployment and aspects of their U.S. business strategy, are probably going to remain capital rich, but not so much earnings, maybe capital rich earnings poor, so to speak. Scotiabank going through a bit of a strategic review, CIBC obviously trying to figure things out domestically. So, it gives you a sense that there will be a bit of a distinct disaggregation in that monolith. And I think you're already seeing that, to be honest with you. If you look at the relative values, if you think about dividend yield, we talk about that a lot over here. Dividend yield of the lowest dividend yield, National Bank, versus the highest dividend yield, I think it's around Scotiabank, or when we did this exercise a few weeks ago, that yield differential is around a one standard deviation move, so to speak, relative to history, past 20, 25 years. So the market is already providing some amount of differentiation over there. I can't speak to the ZEB, but I can tell you in our fundamental approach, we've chosen to take a bit of a barbell approach where we have both expensive bank and I'll call it cheap bank from a valuation perspective to kind of construct a bit of a outperformance. And coincidentally, or by sheer luck, so to speak, the two that we rate outperform, National Bank, a high multiple bank from booked value, dividend yield perspective, and CIBC, probably the cheapest bank now on a book value basis and one of the higher yielding ones, certainly calendar year to date, have outperformed the bank index by sheer luck. But having kept our a toe both in the cheap and a toe in the high quality defensive, I think we've been able to benefit from periodic moves back and forth. I suspect if Chris and I are right and we're moving towards again, I don't want to think of the banks as a monolith, but I suspect if money starts flowing towards the banks, which I suspect will as we look towards 2025, you would expect it's coming in not to play defense, but it's coming in to play offense. I would expect that will result in a bit of a narrowing as opposed to further diverging, some convergence as opposed to more divergence of those valuation multiples between the cheap and the expensive, if you will, whether it's on price to earnings, price to book, or a dividend yield. So a bit of a mouthful, but I think near term, those ones that are able to show better earnings growth, probably because of acquisitions or in the first instance, ought to be a bit more in favor, but taking some sort of a equal weighted approach probably allows you to also keep your toe in the water with the cheaper ones as well.
Thanks, Sohrab. I think we should hire you for our product team, because I think, Chris, what do you think? You think a barbell bank ETF in the future to complement our equal weight bank ETF? I think it's a great idea.
Barbells are always nice, that you get they help balance each other out. So yeah,
Exactly.
they are often a good way to do it.
Let's continue on that theme. And Chris, the next two questions are for you. Sorry, by all means, feel free to chime in, but I do want to continue on that theme, because Chris, you're actually going to be managing shortly a new long-short ETF that we're going to be launching in October, which gives you some unique perspective here. Talk to us a little bit about what does the short interest look like in the Canadian banks right now? And in your opinion, what are some of the things that might either attract someone to shorting the Canadian banks, and what might detract someone from the idea of shorting the Canadian banks?
Yeah, for sure. So short interest right now, it's pretty muted overall on the big six banks. So somewhere between, call it 1% and 4%, just under 4%. I have CIBC as the most shorted bank right now at 3.6 and Scotia at 3%, but I'd say relatively benign overall. Now, I just want to caveat to say this data is by no means authoritative. It's estimate. It's so there's that, but from what we see, relatively benign. Of course, the U.S. hedge funds, somewhat infamously, have taken a couple cracks at shorting Canadian banks, usually driven by concerns about the housing market. In general, those kinds of, if you want to call them attacks, maybe that's a little strong, but they haven't worked out so well as long-term trades. I remember in the mid-teens, that was a big theme, mid 2010s, right? And as we know, real estate and the Canadian banks kind of had a great close to the 2010s. So that's one of the things that can attract them. And conversely, by the same reasoning, I think banks have proven to be very solid, not to beat the drum too much, but long-term investment and high quality companies. And you tend, and in the new strategy, thank you for mentioning long short, the types of companies we want to focus on underweighting or shorting would be kind of more the lower quality companies. So in general, banks don't really fit the general model in terms of one that you would have to have a large short. But yeah, so that's some of the dynamics are there. Yeah, so it's a little tricky when you want to short stocks, you want to kind of really identify something that's lower quality overall. Doesn't tend to characterize the Canadian banks though.
Chris, I want to continue with the next question for you. Sohrab, by all means, feel free to chime in on this one as well. This is more of a macro level. I think it was last week, Bank of Canada held their rates steady. They noted that since the July rate hike, GDP growth sort of was revised lower for Q1. It was well below expectations for Q2, tracking significantly weaker for Q3. And yet they did say, and I'll quote them here, the Governing Council remains concerned about the persistence of underlying inflationary pressures. This does not seem to paint a very rosy picture for the environment in which these Canadian banks are operating. Talk to us a little bit about the U.S. banks. How are they performing? More specific, are there differences between sort of the mega cap banks in the United States and the regionals? What's going on in that market?
Yeah, for sure. So I think there's definitely, we saw some major differences in the regionals. Of course, in March, it was, the regionals that came under heavier pressure in general, and saw a small handful of them fail, but they were large regionals. The complexion, as we know, the U.S. banking market is quite different than Canada. Or Canada, we really think about the big six primarily, and then there's a couple others kind of, I suppose you could say, regional on our side. But but in the US, it's a much more fractured market overall. Yeah, so the regionals came under a lot of pressure. You know, they've bounced back, but keep in mind they're bouncing back from a larger decline. And you know, the most recent earnings cycle, I think what we saw was some better earnings out of U.S. banks, particularly the larger banks. And you know, so think the J.P. Morgans, the Bank of America. So we saw in general some better performance there. You know, I think the big question, though, to go back to the point of the operating environment is the macro, right? And so it's this distinction between the no landing scenario, the soft landing, and the hard landing. And in the U.S. so far, you know, consumers and employment, you know, like tight labor market, have kind of kept that needle somewhere between the no landing and soft landing scenario, I'd argue. But what you are seeing, to your point, is central banks getting a little more aggressive. We just saw the ECB, the European Central Bank, somewhat unexpectedly raise rates 0.25%. So they've raised rates close to 5% in about a year and a half, similar to the US. And that's going to create some economic pressure. So again, you know, it's kind of nothing new to see kind of an economic slowdown at the end of the hiking cycle. I think as investors, we should certainly prepare for that and be aware of it. You know, having some defense in your portfolio, I think is you know, makes a lot of sense right now. You also want to have probably some growth in your portfolio if we do get that no landing scenario. You know, where do banks fit in? Well, traditionally a little more cyclical. So when you know that you have to be careful with them. But again, what I think, what I'm kind of interested in is what kind of opportunities may be presented. So I think, you know, on a longer term time horizon, time is your friend in the case of investing, and sometimes not trading out of positions or acquiring positions over the years, building them up tends to be a good strategy. But potentially with this operating environment, we're going to have better, you know, entry points in the next few months. So, you know, often it's the, you know, the investors who are able to say, you know, I'm willing to buy when most other investors are sell, tends to be, you know, a little bit better. You know, as Warren Buffett famously said, you know, I can't say it any better, is, you know, you want to be greedy when others are fearful and fearful when others are greedy. Great quote. And so, you know, in this environment, and, you know, again, the next 3 to 6 months, a lot of uncertainty. You know, we do have the central banks, again, trying to seemingly slow down economy to slow down inflation. You know, what kind of opportunities is that going to create? And, you know, again, you know, when I think about taking risk in the portfolio, I want to take risk with exposures I think are going to be beneficial over time. And I do think the Canadian banks are going to fit that bill. Sorry, I transitioned from US banks to Canadian banks, maybe somewhere through that. US banks, you know, again, just a little more risky than Canadian banks. So I tend, and I'm not sure, Sohrab, if you'd agree, I tend to think of them as even more cyclical. So I would just, you know, personally, I take a little bit of a cautious approach on the sizing. But again, you know, I think about what kind of opportunities might come and being ready to take advantage of those.
Excellent. Thanks very much, Chris. Sohrab, I want to end off with a question for you, a question specifically. We've talked about this issue in the past, capital ratios. You've stated in the past, capital ratios were very, very healthy. And correct me if I'm wrong, I think currently Canadian banks have to keep a common equity tier 1 capital ratio at least 11.5%. But there's been talk of the regulators potentially increasing that to 12%, and I think as soon as December. So can you talk to us a little bit about how are current capital ratios compared to this potentially higher level? Should we expect equity sales from the banks as a result? And how do you expect the market to react to this?
So it's a regulated business. The regulator primarily looks to the amount of equity capital that's on the balance sheet, because, you know, if you misprice your, I mean, it's a levered business, right? So therefore, if you misprice your assets by, you decide 5%, you could wipe out your equity. The regulator usually regulates you to your capital because they're worried about the depositors in the first instance. And so I think we have a very solid regulatory environment here. I think the banks are very well capitalized. The regulatory minimum today in Canada is 11.5%, but just for crystal clarity, that includes about 3.5% of what let's loosely call a counter-cyclical buffer or a domestic stability buffer, one that basically is a capital ratio you build, essentially, as the regulator likes to call it. You buy insurance during good times so that you could actually release it during difficult times, so that the banks can continue to play that shock absorber type role that you need them to in an economy. As it turns, you want loans to be flowing and what have you. The range for this shock absorber, the domestic stability buffer, officially called, or the countercyclical range, has another 50 basis points on it. The regulator in Canada reviews this every 6 months or so twice a year. The next review is December, like you noted, and I think broadly speaking, certainly our working assumption is that they will take it up to 12% or add the final 50 basis points remaining on the range. But still, the rule or the expectation is that that's because there's ample capital in the system, not because they're trying to force the banks into equity sales and what have you. So I guess long way of saying, no, we don't anticipate a further bump in the capital levels for the banks through the domestic stability buffer in December to result in equity sales by the banks, largely because they are not instantaneous. Yes, market discipline may start asking of the banks, are you within compliance? All the banks today are in the 12.2% and above. So you would say, even if the regulatory minimum moves to 12%, the banks as of last quarter were already clear of that higher regulatory minimum. And the regulator in Canada has historically been disciplined but rational, right? So they don't necessarily say, and you need to comply by this next week. There's usually a 5 or 6 month period to comply, which gives a couple of quarters of internal capital generation. One of the important attributes of the Canadian banking system is that they are, comparatively speaking, higher ROE banks. Obviously, higher capital ratios will kind of squeeze that ROE a little bit, but there's still very good internal capital generation because of those kind of premium ROEs. And so even if a bank is close to that 12% line, there could always be, assumed higher 12% line, there could always be unforeseen circumstances, legal charges, what have you. There would be a couple of quarters of internal capital generation. So not worried about it from an equity issue perspective. But look, it's a regulated business. If the capital levels continue to grind higher, which is the phase we are going through right now, and you have an emboldened kind of regulatory environment globally post the Silicon Valley debacle in the US, we would expect that to be a bit of a headwind on ROEs for the banks, right? So don't worry about the capital issues from a capital adequacy perspective, kind of worry more from a return on equity, and therefore, what does it imply from a valuations perspective? That's how I think I would basically leave it there. I think the resilience of the ROEs are good, but certainly they hard to make a case why they would be going higher from here if the denominator continues to drift higher.
Guys, thank you very much. I love these sessions, the insight from you guys. Chris, love the insight again about the data dive that you take on, in years of negative performance, what kind of positive performance do you have in the following year on the banks? Sohrab, love that disaggregation of the so-called monolith, and, how the next couple of years are going to be driven by the individual bank's growth strategy. Really, really great insights from you both, as always. Thank you for doing this. As a reminder to the audience, you can get exposure to the Canadian banks via ZEB, which is the BMO Equal Weight Canadian Bank Index ETF. You can get exposure to our US banks via ZUB or ZBK, which is the BMO Equal Weight US Banks ETF. And if you have any questions, please don't hesitate to visit the ETF Center at bmoetfs.com. That's all for today, folks. Thank you for tuning in. Please join us in December for the next update on the Canadian banks.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.